Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about the hidden world of trading that's happening right now at speeds we can barely comprehend. We're diving into algorithmic trading, this massive force that's completely flipped modern finance on its head, swapping out noisy trading floors for silent server farms and gut feelings for cold, hard code.
I mean, just try to picture it. Trades are being executed faster than a human eye can even blink. It sounds like something out of a movie, but it's not. This is the reality of the financial markets today. It's a full-blown revolution, all powered by algorithms that are analyzing, deciding, and acting before we've even had our morning coffee.
So here's how we're going to break it all down. First, we'll look at this financial revolution and how we got here. Then, we'll get into what algorithmic trading actually is. After that, we'll peek inside the automated playbook to see the strategies. We'll also look at the good and the bad, the double-edged sword. And finally, we'll wrap up with why any of this really matters to you.
First up, this financial revolution. I mean, how did we even get to this point? The change has been absolutely mind-blowing. We've gone from these iconic, chaotic trading floors, people yelling, paper flying everywhere, to these quiet, sterile server farms where all the action happens with near-perfect, silent precision.
And this whole journey happened incredibly fast. Before the 70s, it was all shouting and hand signals. Then the 70s and 80s brought in the first electronic systems. But the 90s? That's when things really took off with electronic communication networks, or ECNs, which let people trade directly. Then, boom, the mid-2000s hit, and high-frequency trading, HFT, just exploded. And that brings us to right now, where AI and machine learning are making these things smarter every single day.
Okay, so let's get down to brass tacks. When we throw around the term algorithmic trading, what are we really talking about? Turns out, the core idea is actually pretty straightforward.
At its heart, it's just using a computer program with a set of rules to do all the heavy lifting for you. The whole point is to use pure computational power to make really fast, data-based decisions and, crucially, to take human emotion and guesswork completely out of the picture.
You can really boil the whole process down to three key functions. First, the algorithm just inhales a ridiculous amount of market data, way more than a person ever could. Second, based on the rules it was given, that's its strategy, it makes a decision, buy or sell. And third, it pulls the trigger and executes the trade, automatically in a literal fraction of a second. That's it, analysis, decision, execution. Simple as that.
So what's actually in this automated playbook? I mean, how do these programs figure out what to do? This is where we get into the really cool stuff, the actual strategies. Generally, these algorithms are built on one of two major schools of thought. On one side, you've got fundamental analysis. This is all about digging into a company's health, its earnings, the economy, to figure out what it's really worth. On the other side, you have technical analysis, which couldn't care less about any of that. It just looks at charts, hunting for patterns to guess where the price is headed. It's kind of like the difference between asking, is this a good, solid company, versus asking, hey, which way is the herd running right now?
Now, while some algorithms do use fundamentals, a lot of the really famous strategies are purely technical. Let's start with the first big one, trend following. The idea here is so simple it's almost beautiful. You remember that idea from physics? An object in motion stays in motion? Well, that's the whole strategy. The algorithm is programmed to bet that once a price starts moving in a direction, it's probably going to keep going that way.
A super classic example of this is something called the golden cross. So imagine you've got two lines on a chart tracking the average price, one for the short term, one for the long term. For a while, the short-term line is hanging out below the long-term one, but then it crosses above it, and bam, that's the buy signal. The algorithm sees that crossover and says, okay, momentum has shifted. A new uptrend might be starting. Let's get in.
Now, our second big strategy, mean reversion, is basically the polar opposite. If trend following is about momentum, think of this one as being about gravity. The best analogy is a rubber band. The core idea is that prices can stretch away from their average, for sure, but eventually, they're gonna snap back.
So how does an algorithm see that rubber band stretching? Well, a really popular tool for this is called Bollinger Bands. You get a middle line, which is the average price, and then an upper and lower band around it. If the price touches that upper band, the algorithm thinks, whoa, that's stretched too far, it's overbought, and that can trigger a sell signal. And if it hits the lower band, it's seen as oversold, creating a potential buy signal. It's all about betting on that snap back to the middle.
Okay, so this all sounds incredibly powerful, right? But it's not all sunshine and rainbows. For all its advantages, algorithmic trading is absolutely a double-edged sword. there are some serious risks involved.
On the one hand, the pros are massive. These things never sleep, they react instantly, they take emotion completely out of it, and they can analyze data on a scale that's just not humanly possible. But the flip side is just as real. A single tiny glitch in the code can cause a catastrophe. Wild market swings can completely wreck a perfectly good strategy. And of course, trying to keep up with all the financial rules and regulations is a nightmare.
So you might be thinking, all right, this is all fascinating for big Wall Street firms, but why should I care? And that's the key question, right? Because the truth is, the rise of algorithmic trading has a huge impact on the entire financial system that affects all of us.
The impact is enormous. For starters, these algorithms provide what's called liquidity. That just means they're always there, ready to buy or sell, which makes trading easier and cheaper for everyone, from a giant pension fund down to an individual investor. They lower transaction costs, they make global 24/7 trading possible, but maybe the biggest thing is this. It started to democratize finance. Platforms are now offering tools powered by these same ideas, giving everyday traders access to a level of sophistication that used to be reserved for the big guys.
And that really brings us to the big final question to chew on. We've seen how these machines have taken over with their incredible speed and logic. But as they get smarter and smarter with AI that can actually learn and adapt on its own, it really makes you wonder. In a world where trading decisions are completely automated, what's left for us? What's the role for human creativity, for judgment, for that simple gut feeling? It's definitely something to think about.
Today, we are diving deep into the engine that powers modern finance, algorithmic trading. You can just forget those old images of trading floors with people shouting and waving paper around. We're in a whole new world now, an era where billions of dollars move in the blink of an eye, all driven by lines of code. We're going to break down how this incredible high-speed world really works, pulling insights from Kalara Koru and what it all means for the future of money.
This quote, it just nails it, doesn't it? It really captures the scale of the change we're living through. This isn't just about making things a little bit faster. Nope, this is a fundamental rewrite of the DNA of how markets work. And that creates these massive, unbelievable opportunities, but also, you guessed it, entirely new kinds of risks.
So let's really explore this new landscape. The world of finance has gone through a seismic shift. I mean, the old ways of trading, they were great for their time, but now? It's kind of like bringing a horse and buggy to a Formula One race. The speed, the sheer complexity of today's markets, it just demands a completely different kind of machine.
And this comparison really shows you the heart of that change. We've gone from relying on the gut feelings of a human trader to the cold, hard precision of an algorithm. I mean, think about that. Trades that used to take minutes now happen in microseconds. That is literally faster than you can blink. And where analysts used to spend weeks digging through reports, an AI can now spot hidden patterns in mountains of data, opportunities that are completely invisible to the human eye.
Yeah, this whole new world isn't just about being fast for the sake of being fast. It's about creating entirely new paths to profit. For the people who can build and really master these tools, the potential to make serious returns is, bigger than it's ever been. But how do you actually do that? How do you harness that power?
Well, the key is understanding the tool at the center of it all, algorithmic trading. Let's stop thinking about it as some kind of scary, mysterious black box. Instead, let's look at it for what it is. It's our guide, it's our compass and our map for finding our way through this new financial territory. At its very core, this is what we're talking about. It's where incredibly smart code meets deep financial know-how. And the goal? To make trades at a speed and on a scale that no human being could ever hope to match. It's about taking human strategy and just supercharging it with the brutal efficiency of a machine.
So how does it actually work? Well, you can think of it as this constant, relentless, three-step cycle that just never stops. First, the algorithms are tirelessly scanning the markets, just drinking in enormous amounts of data in real time. Then, they're hunting for very specific patterns, those little glimmers of opportunity that match their programming. And finally, bam! When the conditions are perfect, they execute trades with surgical precision. All of that before most of us have even had our first sip of morning coffee.
And let's be really clear about this. This isn't some tiny niche strategy for a few geeks in a back room. Algorithmic trading has become the absolute backbone of the modern financial system. It's how the most successful traders, the biggest institutions on the planet, it's how they operate and compete today. It's the name of the game.
Okay, so we get the what, right? Now let's dig into the how. How do you go from just knowing what this is to actually mastering it? Well, the source material lays out a super clear path, and it's built on 4 essential pillars. Think of it as the ultimate toolkit for anyone who wants to win in this field.
First up, strategies. This is definitely not a one-size-fits-all kind of thing. Real mastery means you have a whole toolkit full of different approaches. Maybe that's a slow and steady algorithm designed to ride long-term trends. Or maybe it's a lightning-fast system built for high-frequency trading. You gotta have the right tool for the right job.
Second, and I can't stress this enough, is risk management. It's described here as an art, and that's exactly what it is. It's the art of making sure your strategies aren't just profitable, but that they're tough enough to survive the crazy storms and flash crashes the market's going to throw at you. It's all about building resilience and, most importantly, protecting your money. The third pillar is technology. You have to get what's under the hood. You have to understand the engine. And that means getting comfortable with powerful programming languages, maybe like Python or C++, and understanding the whole software and hardware setup that makes these seamless, high-speed trades even possible.
And finally, there's the real world. Theory is great, but it'll only get you so far. The deepest learning happens when you study what happens when code actually meets capital. That means you got to dive into the case studies. Learn from the huge successes for sure, but maybe even more importantly, learn from the epic failures and the really costly mistakes.
So what happens when you put all 4 of those pillars together? You've got strategy, risk management, technology, and real-world application. Where does that lead? It leads directly to the future of trading. And what's being presented here isn't some exclusive, closed-off club. It's an open invitation for you to jump in and be a part of it.
And this invitation is genuinely open to everyone. It doesn't matter if you're an aspiring trader just starting out, or a seasoned pro who wants to stay ahead of the curve. Maybe you're a financial investor who just wants to understand the market better. Or maybe you're just curious about how tech and finance are colliding. There's a place for you on this journey.
In the end, it all comes back to this one powerful idea. Learning about algorithmic trading isn't just about picking up a few technical skills. It's about getting your compass. It's the one tool that can give you the power to confidently navigate the crazy, complex, constantly changing world of modern finance. So, the last question is really for you. The map is right here. The tools are within reach. This journey into the future of finance is starting right now. The only real question left is, are you ready?
All right, let's dive into one of the most powerful and maybe one of the most invisible forces in modern finance, algorithmic trading. It's this hidden engine that's constantly humming away, driving the global markets. And today, we're going to pull back the curtain and break down exactly what it is, how it works, and why it has totally changed the game for everyone.
Just stop and think about this for a second. What if a machine could analyze the market, make a decision, and then act on a trade in a tiny fraction of a second? Well, that's not some kind of sci-fi movie plot. It's the reality of our financial markets right now, today.
So what is algorithmic trading really? It's one of those terms that sounds super complex, maybe a little intimidating, but the core idea? It's actually pretty straightforward once you get into it.
Okay, the K phrase here is minimal human intervention. The best way to think about it is like a master chef who writes down a super precise recipe for a robot. A programmer sets the rules, right? Something like, if this stock's price drops by 2%, sell it immediately. And the computer just does it flawlessly, without hesitating, without second guessing, every single time.
Yeah, the whole point of this is to take human emotion completely out of the equation. All that fear, greed, that moment of hesitation, get rid of it. It's all about replacing those gut feelings with pure, cold, hard data, and then making moves at speeds that no human could ever hope to match. So that's the what. But what about the how? How does one of these algorithms actually pull off a trade in the real world? Let's trace the path step by step.
Now, here's the really wild part. This entire 4-step process can happen in microseconds. Seriously, an algorithm can scan the market, find an opportunity, make a decision, execute the trade, and manage its risk faster than a person can even realize that opportunity was there in the first place. It's just this constant, lightning-fast cycle, over and over again.
Now, you might be thinking, do they just, switch these things on and just hope for the best? No way. Absolutely not. Before an algorithm ever gets to touch a single dollar of real money, it goes through this crucial process called backtesting. It's kind of like a flight simulator for a trading strategy. They run it against years and years of past market data to see exactly how it would have performed. And inside these big strategies, the algorithms use different tools to get the job done. A simple market order just says, get it done now at whatever the price is. For more precision, they might use a limit order, which says, only buy or sell if you can get me this price or better. And for really big trades, they can use something called a TWAP order. It stands for time-weighted average price. This basically breaks up a huge order into little tiny pieces over time so they don't cause a huge splash and disrupt the market.
But, this super advanced tech didn't just appear out of thin air. The evolution from traders literally screaming at each other in a pit to these silent thinking machines, well, it's a story of some seriously mind-blowing acceleration.
Just look at how fast this all happened. We went from traders in those colorful jackets shouting in a pit to the very first basic electronic systems. Then, in the 90s, ECNs let computers talk directly to each other, which was a huge deal. But the real revolution, the game changer, came in the mid-2000s with high-frequency trading. Suddenly, speed was everything. And that's what brought us to today, to the AI era, where the machines have actually started to think for themselves.
So what is high-frequency trading, or HFT? Well, it's basically the Olympic sprint of the trading world. This is a universe where firms will spend millions of dollars just to put their servers in the same physical building as the stock exchange, just to shave a few nanoseconds off the travel time of their data. We are talking about a race to profit from tiny, microscopic price differences that might only exist for less than the blink of an eye.
And this is where things get really, really mind-bending. The algorithms running the show today aren't just following a static rulebook anymore. Thanks to machine learning and AI, they can analyze new data, they can spot new patterns, and they can actually adapt their own strategies in real time, all without a human programmer having to step in. They are literally learning on the job.
So we have this incredibly fast, incredibly intelligent technology running loose. But so what? Why does any of this matter to the financial markets as a whole? What's the real impact on the ground?
The impact is absolutely massive. These algorithms add liquidity to the market, which basically means it's easier for anybody to buy or sell something at a fair price. They make markets way more efficient by pouncing on price discrepancies almost instantly. They've driven down the cost of trading for everyone, and like we said, they do it all without emotional bias, which creates a more disciplined, interconnected, 24/7 global market.
And make no mistake about it, this is not some passing trend. This technology is fundamentally reshaping the entire world of finance, and its influence is only getting bigger.
But of course, it's not all sunshine and perfectly efficient markets. With this incredible power and speed comes a very unique set of challenges and some very, very serious risks.
And this really shows you the central trade-off, doesn't it? On one side, you have this incredible, unmatched efficiency. But on the other, a single bad line of code or a technical glitch can cause absolute chaos in seconds. A sudden, unexpected market event can completely break a strategy that worked perfectly on all the historical data. And all of this power has to operate inside this tangled web of financial regulations.
This is the tightrope that the entire industry is walking every single day. Everybody wants to be faster, everybody wants to be smarter, but at the same time, regulators and the firms themselves are constantly trying to build in guardrails to keep this high-speed system from spinning completely out of control.
Okay, so let's boil this all down. What are the key things to remember? First, algo trading is just using computers to automate trades based on a set of rules. Second, it's evolved like crazy, from simple stuff to complex AI that can actually learn and adapt. Third, its biggest impact is making our markets way faster and more efficient than ever before. And finally, the whole systems is this high-stakes balancing act between the amazing benefits of speed and the scary risks of technical failure.
And that really brings us to our final thought. As these trading machines get smarter and faster and more predictive than we can even really comprehend, it leaves us with a really critical question about the future of finance. Who, or maybe what, is truly in the driver's seat?
So you tap that buy button on your phone, and boom, just like that, you own a tiny piece of a company. But what actually happened in that split second? What invisible high-speed machinery just kicked into gear? Well, that's exactly what we're digging into today, the hidden world behind a single click. Okay, let's get into it.
It's something we just don't think about, right? But that one simple tap unleashes a massive chain reaction across a global high-speed ecosystem. And in the next few minutes, we're going to follow that chain link by link to see where it leads.
So here's our game plan. We'll start with the big picture view.
what the financial marketplace even is. Then, we'll zoom in on the different arenas where trading happens, meet the key players in the game, and figure out how your order is actually placed. And finally, we'll get to the heart of it all, how prices are set, and how algorithms have pretty much mastered this whole process.
For just a second, I want you to forget all those intimidating charts and the flashing red and green numbers. At its core, the financial marketplace is just, well, a marketplace. Think of it like a colossal digital bazaar, where millions of people from all over the world come together to buy and sell stuff.
And just like any huge marketplace, it's not just one giant messy free-for-all. Nope. It's actually really organized. It's divided up into these specialized arenas, and each one has its own vibe and its own set of rules.
So you've got the stock market. That's the one we all know, right? Where you buy a slice of your favorite companies. Then there's the Forex market, this absolutely enormous arena for trading currencies. You've got the crypto markets, the new kid on the block for things like Bitcoin. And of course, markets for more complex stuff like derivatives and bonds. Each one is its own universe, but they all boil down to the same thing: people buying and people selling.
So who are you actually trading within these arenas? You might think it's just you against the machine, but it's really not. A trade is more like a complex dance with a bunch of different partners, and you, the retail trader, are a really important part of that dance.
All right, so first up, there's us, the retail traders. That's you and me. Then you've got the big guys, the titans, institutional investors like hedge funds, and they're moving huge amounts of money. Market makers are like the grease in the wheels. They're always there, ready to buy or sell to keep things moving smoothly. And then, the speed demons, the high-frequency traders, or HFTs, with algorithms that work at just unbelievable speeds.
Okay, the stage is set. The players are all here. Now, it's your move. When you decide you want to buy or sell, you're not just throwing a wish out into the universe. You are giving the market a very precise set of instructions, and we call that an order.
And this slide breaks down the two main flavors you can choose from. A market order is basically the now button. It screams, "Get me this stock right away," at whatever the best price is. A limit order, on the other hand, is the if button. It says, "Get me this stock, but only if it hits this exact price or better." So one is all about speed, getting it done now. The other is all about control, getting the price you want.
And that's the fundamental trade-off every single time. What's it going to be? Speed or control? Are you okay with maybe paying a tiny bit more just to know for sure that the trade is done? Or are you willing to risk missing out on the trade entirely just to hit that perfect price? It's a choice you have to make with every order.
No matter which you choose, your order is about to enter a micro battleground called the price spread. This is where the magic happens. It's this tiny little space where the final price of your trade is actually born.
Okay, so the bid-ask spread. All it is really is the tiny gap between what buyers are willing to pay for something and what sellers are willing to sell it for. It sounds small, but trust me, this tiny gap is where everything happens.
Let's break that down. First, you've got the bid. This is the highest price that any buyer out there is publicly saying, "I'll buy it for this much right at this very moment." It's pure demand right there for you to see.
And then on the flip side, you've got the ask. That's the lowest price any seller is publicly saying, "I'll sell it for this much." That's your supply. And yep, the ask is always just a little bit higher than the bid. So why is this so important? Well, because that little spread is basically the cost of doing business. You always have to buy at the higher ask price and sell at the lower bid price. A really tight, narrow spread, that's a good sign. It means the market is busy, liquid, and healthy. A wide spread? That's like a higher fee. It tells you things are a bit quieter, maybe even a little riskier.
Okay, so let's tie this all together. We've got the players, we've got the orders, we've got the price spread. Now we get to see how modern machines, how algorithms absolutely master this entire game.
So these algorithms, these HFTs, they're built to do everything we just talked about, but at a speed that is just mind-bending. They can scan millions of bits of info, find the absolute tiniest, most fleeting opportunities in that bid-ask spread, and fire off thousands of orders, all in less time than it takes you to blink. It's the same game, just played on a totally different, superhuman level.
And look, the magic trick here isn't some super secret complex formula. It's just a perfect, lightning-fast understanding of the very basics we've just walked through. They've just mastered the rules of the game so completely that they can play it faster than any human possibly could.
So, when you click that buy button, your order joins this incredibly complex dance. And while you or I have to navigate it one decision at a time, you have algorithms playing this same game across thousands of stocks at once, at pretty much the speed of light. And that leaves us with one big question. In a world that's all about speed, what's our role as human traders?
Hey there. Today, we're going to crack open the code behind the world's financial markets. We're going to look at how investors, and these days super smart algorithms, decide when to buy, sell, or just hold on. Yeah, it all really starts with this one massive question. Is it all just random chaos, or is there actually a method to the madness? Well, it turns out there absolutely is, and it's all about analysis. See, behind every single trade, there's a brain, whether it's human or artificial, making a very calculated bet. That's exactly right. Investors and algorithms, they don't just guess. They're using specific techniques to evaluate markets, to figure out what a company is really worth, and to try and predict where prices are headed next. Basically, they're making smart, informed decisions. Okay, so while there are a ton of different strategies out there, most of them really fall into two big categories. You can think of them as two completely different philosophies for understanding the market. This is really the fundamental split in how traders see the world. And here they are. On one side, you've got fundamental analysis. This is kind of like being a detective. You're digging deep, asking why a company is a good investment. Then, on the other side, you have quantitative analysis. This is all about being a mathematician. You're just looking at the raw data, the numbers, the patterns, and asking what they're telling you about what's coming next. So let's take a closer look at the detective's approach, right? Fundamental analysis is all about finding a company's intrinsic value. Here's a simple way to think about it. The stock price is just the price tag you see in a store, but the intrinsic value, that's what the item is actually worth. So this whole approach is about trying to figure out that true worth by looking at the company's health, who's running it, and the overall economy. Okay, now for the mathematician's side of things. Quantitative analysis, or quant for short, really doesn't care about a company's management team or its mission statement. Nope, it's all about the hard numbers. It's about running historical data through some seriously sophisticated math and statistical models to find patterns that just might predict where prices are going to go. All right, so let's start with the detective work. How in the world does an algorithm step in and play the part of a fundamental analyst? How does it try to figure out a company's real, true value? So where does an algorithm get the edge? Well, it really comes down to two things: speed and scale. I mean, think about it. A human analyst can study, a handful of companies? But an algorithm? It can process just colossal amounts of data on thousands of companies in a matter of seconds. It's scanning earnings reports, economic news, all of it, instantly, to make these data-driven decisions. So what exactly is it looking at? Well, first, it starts with the big picture. The algorithms analyze these key economic indicators. They're looking at things like GDP to see if the economy is growing, unemployment rates to get a feel for consumer health, and of course, inflation and interest rates to understand the bigger financial climate. All this stuff influences a company's chances of success. And then, after looking at the big picture, the algorithm zooms way in. It's like it's checking the company's vital signs by scanning all its financial statements. It's looking at key ratios, like the price to earnings or PE ratio, to see if a stock is a bargain or way too expensive. It checks the debt to equity ratio to see how much risk the company's taking on. And it looks at the return on equity, the ROE, to see just how good the company is at making money for its investors. And really, that's the whole point of this entire exercise. By mixing that big picture economic data with the nitty-gritty company financial data, the algorithm has one goal: calculate that intrinsic value we talked about earlier. And then it makes the call. Is the stock a bargain or is it overpriced? Okay, let's do a complete 180 now. Let's switch gears and jump over to that other school of thought. We're going to see how algorithms trade based on pure mathematics, statistics, and piles of historical data. Welcome to the world of the quants. This right here, this quote perfectly captures the core belief behind quantitative analysis. It's this idea that the past can, to some degree, predict the future. The entire strategy is built on one thing: finding historical patterns in market data and then betting that those patterns are going to repeat themselves. So, how do they actually find these patterns? Well, they use some really powerful statistical models. For example, regression analysis looks for relationships between things, like how an airline's stock price might change when oil prices shoot up. Time series analysis looks for trends over time. And then you have volatility models that try to predict just how much a stock's price is going to bounce around tomorrow. So all of these complex models, they basically become the instruction manual for the trading algorithm. The moment the models spot a pattern they've been programmed to find, say a potential trend reversal, the algorithm just pulls the trigger. It executes a trade automatically, often in a fraction of a second. It's unbelievably fast. Now, if you think that sounds advanced, you might want to hold on to your hat. We're now seeing a huge evolution in the quant toolkit, and it's called artificial intelligence, specifically machine learning. And believe me, it is taking this numbers-first approach to a whole other level. And the real game changer with machine learning is right there in the name. These algorithms actually learn from experience. So instead of just following a set of rules someone programmed into them, they can analyze insane amounts of data and uncover these incredibly complex patterns that no human and no traditional model would ever find. They literally get smarter over time. And this learning happens in a few cool ways. First, you have supervised learning. That's where you feed the AI historical data where you already know what happened, like, hey, these conditions led to a price jump. Then there's unsupervised learning. Here you just dump all the data in and tell it, go find something interesting. And it can discover these hidden connections all on its own. And finally, my favorite, reinforcement learning. This is where the AI learns just like a character in a video game, through trial and error. It gets rewards for good trades and penalties for bad ones, and it's constantly tweaking its strategy to get better. So what's the big takeaway here? It's that it's not really detective versus mathematician anymore. The future, and honestly the present, is a hybrid of the two. The most advanced systems are now using AI to find quantitative patterns inside of fundamental data. I'm talking about things like analyzing the sentiment of news articles or earnings calls on a massive scale. It's truly the best of both worlds, and it's all being supercharged by machine intelligence. And this, of course, brings us to the final, really critical question. As these AI-driven systems keep learning, adapting, and evolving at a speed we can barely even wrap our heads around, what does that mean for the future of the human investor? It's a question everyone in finance is wrestling with, and the answer is going to define the next chapter of the markets. Thanks for tuning in. So every single day in the massive global financial markets, countless trades are happening. But here's the thing. They're not being made by people. They're being executed by automated algorithms, trading bots, and they operate at speeds we can barely even wrap our heads around, moving huge amounts of money in literally the blink of an eye. But have you ever stopped to wonder what's actually going on inside their code? I mean, what's the logic? What's the core idea that's driving all these automated decisions? It's easy to picture some single super smart AI pulling all the strings, but you know what? The reality is way more interesting than that. See, these bots aren't all built the same, not even close. Each one is designed around a very specific strategy. You could almost call it a unique philosophy about how the market actually behaves and where you can find the profits. They are, basically, digital versions of competing economic ideas, all battling it out against each other in real time. So in this explainer, we're going to break down 3 of the most powerful of these philosophies. We've got riding the wave, then the return to the average, and finally, the absolutely wild, lightning-fast game of microseconds. You're going to see how these totally different strategies are constantly shaping everything. Okay, first up, the trend followers. Their whole philosophy is actually pretty simple, but really powerful. It's all about finding a market wave and just riding it. This isn't about trying to predict the future. It's about spotting the momentum that's happening right now and jumping on board for the ride. The core belief here is a classic bit of market wisdom. You've probably heard it. The trend is your friend. This strategy basically assumes that momentum is a huge force. A stock that's going up is probably going to keep going up, and one that's falling, well, it's likely to keep falling, at least for a little while. So how do they actually spot these trends? Well, the algorithms have a couple of key tools in their toolbox. Moving averages are huge. They help the bots see the underlying direction by smoothing out all the random, noisy price jumps. And then you have breakout strategies, where the bot is just watching and waiting for a price to punch through a known ceiling or floor, signaling that a powerful new trend has just started. And for the bot, the signals can be incredibly clear, like it's just pure data. For instance, it might be programmed to watch for the exact moment a short-term price average crosses above a long-term one. That event has a name. It's called a golden cross, and it's a classic automated signal to buy. And the exact opposite, called a death cross, is an equally clear signal to sell. It's just momentum chasing, plain and simple.
All right, let's talk about our next philosophy, which is basically the polar opposite of the first one. If the trend followers are out there chasing the wave, these bots, the mean reversion bots, they're the ones sitting on the shore just waiting for that wave to crash and for everything to go back to normal.
The big idea here is that extreme price swings are usually temporary. This philosophy is all about betting that a stock that is shot way up is overbought and is due to fall back toward its average price. And on the flip side, an asset that is totally crashed is oversold and is probably going to bounce back. It's a strategy built entirely on the idea of a financial equilibrium, like a rubber band snapping back. A really common tool for this is something called Bollinger Bands. What they do is create a channel or a band around an asset's average price. So when the live price hits that upper band, it signals to the bot to sell. That's called a short position, because it's betting the price is about to fall. If it hits the lower band, that's a signal to buy, a long position, because it's betting the price will rise. It's a really systematic way of trying to buy low and sell high. This same philosophy also powers a really cool technique called statistical arbitrage, or sometimes pairs trading. An algorithm will track two stocks that are historically linked, right? Think Coke and Pepsi. If, all of a sudden, Coke's stock shoots up but Pepsi stays flat, the bot will instantly sell the high one and buy the low one, betting that their usual price relationship is going to snap back into place pretty soon. And now, for our third philosophy. This one operates in a completely different dimension. Seriously, this isn't about trends, it's not about averages. This is a game of pure, unadulterated speed, and it's all played out in fractions of a second. Right, high-frequency trading, or HFT. These algorithms could not care less where a stock price is going to be tomorrow or even 5 minutes from now. It is all about exploiting tiny, almost invisible price differences that might only exist for a split second. The profit on any single trade is minuscule. We're talking fractions of a penny. So the whole strategy depends on making millions and millions of them. And the speed is it's staggering. We're not talking about seconds here. We're talking milliseconds. That's thousands of a second. Or even microseconds, which are millions of a second. To even compete, these firms use the most cutting-edge tech, and they'll even put their servers in the exact same building as the stock exchange's servers, just to shave off the tiny amount of time it takes for information to travel through a cable. So what are they actually doing at that speed? Well, two big strategies come to mind. One is market making. That's where a bot is constantly posting both buy and sell orders at the same time, trying to make a tiny profit from the price difference, which is called the bid-ask spread. And the other is a supercharged version of statistical arbitrage, where they pounce on these brief pricing mistakes, often mistakes created by the big, slow orders from our trend-following bots before anyone else in the market even knows they happened. So, there you have it. 3 completely different, radical approaches to the market, all competing in the same space. Let's just put them side by side for a second and see how they really stack up. You can just see the difference so clearly here, right? Trend followers are playing the long game, over days, weeks, even months. Mean reversion bots are working on a much shorter time frame, hours to days, betting on those corrections. And then HFT algorithms, they're just in a class all their own, making their moves in microseconds. Their tools aren't charts. Their tools are direct data feeds of the market's order books and that super important physical location. And here's why all this really matters. The price you see for any stock isn't just a simple reflection of human supply and demand anymore, not by a long shot. It is the chaotic real-time result of these competing algorithmic philosophies, pushing and pulling against each other every single moment of every single trading day. And that leaves us with a final, really fascinating question to chew on. What happens when the trend followers, and the contrarians betting against them, and the absolute speed demons all collide at light speed? What does this constant, high-speed battle of algorithms actually mean for the stability, and maybe even the fairness, of our markets? That's something to think about.
Have you ever looked at the stock market and just wondered how a machine can make millions, sometimes in a matter of seconds? Well, today, we're going to pull back the curtain on that. We are building an algorithmic trading strategy right from the ground up. We're going to uncover the blueprint that turns a simple idea into an automated trading machine. So let's dive in.
And really, that's the big question, isn't it? How does a machine, a piece of code, decide when to pull the trigger on a trade? It might seem like some kind of digital magic, but I promise you, it's not. Every single automated trade is driven by a really clear, logical blueprint. And today, we're going to follow that blueprint step by step to find the answer.
You know, every single trading algorithm starts not with a line of code, but with an idea.
a hypothesis about how the market works. We call this the signal. It's that little spark that tells the machine, hey, pay attention, something might be happening here. And usually, these signals come from one of two very different, almost opposite ways of looking at the world.
And here they are. This is the big philosophical divide in trading. On one side, you've got your technical analyst. Think of them as a chart reader. They believe everything you need to know is already baked into the historical price and volume data. Then, on the other side, you have the fundamental analyst. They're more like a company detective, digging into a company's health, its earnings, the wider economy, all to figure out what an asset is really worth.
So, for those chart readers, the toolkit is all about the math. An algorithm can be programmed to spot visual patterns. Things like the peaks and valleys that might signal a trend is about to reverse. Or it can use indicators that kind of smooth out all the noise in the price to identify which way the trend is going and how strong it is. The whole idea is to find patterns in the data itself that might just predict the future.
Now, the company detectives, they're playing a completely different game. Their algorithms are designed to react to information from the outside world. So maybe a super strong earnings report comes out. That could be a buy signal. Or maybe the price-to-earnings ratio gets way out of whack, suggesting a stock is overvalued. This approach is all about understanding the why behind a price move, based on how a company is actually doing in the real world.
Okay, so having a signal is great, but it's just an idea, right? Now comes the hard part. We have to turn that idea into a concrete set of instructions, the actual blueprint the machine is going to follow. And that means defining exactly when to get into a trade, and, just as importantly, when to get out.
Before we can even think about rules for making a profit, we have to talk about something absolutely crucial: risk. And the cornerstone of managing risk is what's called the risk-reward ratio. It asks a really simple question. For every dollar you hope to make, how many dollars are you willing to lose?
And this leads to a really simple but powerful rule of thumb. Your potential wins have to be bigger than your potential losses. This is so critical because, let's be honest, no strategy wins all the time. You're going to have losses. But by making sure your rewards are greater than your risks, one single good trade can wipe out the memory of several small losses. That's how you stay in the game long term.
Let's make this real. Look at this example. Say the algorithm buys a stock at $100. It's programmed with a stop-loss order at 98. That means if the price drops, it automatically sells, and your loss is capped at just $2. At the same time, the profit target is set at 106. So in this trade, the algorithm is risking $2 for a potential reward of $6. That's a fantastic 3-to-1 risk-reward ratio.
So where do you set that profit target? Well, it's not just a random guess. An algorithm can be programmed with different kinds of logic. It might aim for a specific technical level on a chart where prices have struggled before. It could set a target that changes based on how wild and volatile the market is on any given day. Or it could be as simple as, get out of the trade after 2 hours, no matter what.
So we've got our idea and we've got our rules. Sounds pretty good, but how on earth do we know if it would have actually worked in the past? This is where backtesting comes in. Seriously, think of it like a time machine for your strategy. It's the dress rehearsal before opening night. It is the ultimate reality check.
The idea is really simple, but it's so important. You take your strategy, you feed it a mountain of historical market data, and you see how it would have performed. It lets you see all the wins, all the losses, all the close calls, without ever risking a single real dollar. It's like the pre-flight check every pilot runs before takeoff. You just don't skip it.
And the reasons why are huge. First off, could this strategy even make money? A backtest gives you a data-driven hunch. How does it hold up during a crazy market crash or a huge bull run? You can see its risk profile in action. And maybe most importantly, it helps you find and fix the dumb mistakes and logical flaws before they cost you real money.
All right, now for a big word of caution. Backtesting is an incredible tool, but if you do it wrong, it can create a really dangerous illusion of success. There are a bunch of traps that can make a terrible strategy look like a work of genius on paper, only to watch it fall apart the second it hits the live market.
This right here is trap number 1. It's called overfitting. The best analogy is that it's like teaching to the test. You keep tweaking and tuning your strategy until it perfectly explains the past data. But you haven't actually taught it a real market pattern. You've just taught it how to memorize the past. And a strategy like that, one that looks like $1 million winner in testing, can become a total disaster overnight.
Now this one's a little more subtle, but it's just as dangerous. It's called survivorship bias.
See, if your historical data only includes companies that are still around today, you're getting a skewed picture. You're completely ignoring all the companies that went bankrupt, got acquired, or just failed. Testing only on the survivors makes the past look way safer and more profitable than it actually was.
And it doesn't stop there. There are other pitfalls too. Forgetting to factor in tiny little transaction costs can completely erase the profits of a strategy that trades a lot. And constantly tweaking your rules to make your past results look better, that's called data snooping, is just another way to overfit your model. A backtest is supposed to be a one-time test, not a practice exam you can retake until you get an A.
Okay, so after navigating all those steps, from that first little spark of an idea to setting the rules to putting it through that tough, honest reality check of backtesting, we can finally assemble the complete blueprint. And here it is, the entire process laid out in 4 key steps. You start with your signal, your core idea. You translate that idea into concrete entry and exit rules based on risk and reward. Then you test that strategy against the past. And finally, you make sure that test was fair and honest by avoiding all those common traps. That right there is the builder's blueprint.
And, at the end of the day, the goal isn't to build a strategy that looks absolutely perfect on paper. That's like a flawless statue. It's beautiful, but it's brittle. The real goal is to build something robust, something more like a tree, strong enough to survive the unexpected storms of the future and flexible enough to adapt to whatever the market throws at it.
Which kind of leaves us with one final big question to chew on. With all this data, all this computing power, and all this rigor, is trading now a solved science? Or is designing a truly great strategy, one that balances a clever signal with smart risk management, still just as much an art form as it is a science?
Have you ever stopped to think about how a machine can make a trade? I mean, from the initial decision to the final execution, literally faster than you can blink? Well, today we're going to do more than just talk about it. We're going to build one of these incredible systems from the ground up, piece by piece, so you can see exactly what makes them tick.
It really all comes down to this one question. You see, in modern finance, speed isn't just a nice to have, it is everything. That tiny, tiny delay between making a decision and actually acting on it, what the tech world calls latency, can literally be the difference between millions of dollars in profit or loss. And that is the problem these machines were born to solve.
So how do they do it? Look, it's not some kind of financial wizardry. It's just brilliant engineering. And like any powerful machine, it's built methodically, piece by piece, starting with an absolutely rock-solid foundation. So let's get to work and lay that first block. Now, every great structure needs a solid foundation, right? For an algorithmic trading system, that foundation isn't made of concrete and steel. It's all about the technology infrastructure, the raw hardware and architecture that gives it the power to operate at these, frankly, superhuman speeds. Okay, so the physical need for speed gets tackled in 3 really critical ways. First, you need incredibly high-performance servers just to chew through the massive amount of data coming in. Second, you use something called co-location. This is brilliant. It literally means putting your servers in the same building as the stock exchange's servers to cut down the physical distance the signal has to travel. And finally, you need ridiculously fast direct network connections. In this game, every single millisecond counts. But you know what? Raw speed is completely useless if the system crashes mid-trade. That's where these 2 design principles are absolutely crucial. Redundancy means having backups for everything, so if one piece of hardware fails, another one instantly picks up the slack. And scalability means the whole system is designed to grow. As trading gets heavier, the architecture can expand right along with it without breaking a sweat. It's built for speed, sure, but it's also built to last. All right, with our powerful hardware foundation in place, it's time to give this machine a brain. This is where the code comes in, the intelligence, the trading models, the part of the system that's actually going to be making all the decisions. Now, before you would ever let a new algorithm touch a single cent of real money, you have to test it. And this process is called backtesting. I want you to think of it like a flight simulator for a trading strategy. You feed it years and years of historical market data just to see how it would have performed. This is an absolutely essential step to figure out if your brilliant idea actually works in the real world. So, turning a trading idea into a working algorithm is a really methodical process. First, you've got to pick your programming language, something like Python or C++. Then you get to work coding the actual logic, the specific rules for when to buy and when to sell. Next, you run those backtests we just talked about over and over to tweak and optimize it. And finally, and this is so important, you build in bulletproof error handling, because when you're dealing with live markets, you have to plan for the unexpected. Of course, our algorithm can't just operate in a vacuum. It needs to connect to the outside financial world. And it does this using something called APIs, Application Programming Interfaces. Just think of an API as a digital messenger. It's constantly running back and forth, grabbing real-time market data for the algorithm to see, and then carrying the algorithm's buy or sell orders back to the exchange. Without these APIs, the brain has no eyes, no ears, and no mouth. Okay, so our machine is built, and its brain is fully programmed. Now we're at the final, most critical step, taking action. This is the moment the system actually interacts with the live market. And believe me, how it does this is just as important as the decision to trade in the first place. You see, executing a trade isn't as simple as just clicking a big buy button. There are two sides to doing it smartly, the how and the where. The how is about execution. If you try to place one giant order for 1 million shares, you'll spook the market and the price will move against you. So the algorithm is smart. It breaks that big order down into tiny little pieces to avoid making waves. Then there's the where. A system called Smart Order Routing scans all the different exchanges in real time to find the absolute best place to send each of those tiny orders to get the best possible price. So the ultimate goal here isn't just about being fast, it's about being incredibly smart and efficient. It's just like it says here. The whole point is to get the best possible execution by carefully splitting orders across all these different markets and venues. It's a game of microscopic precision, but played out at a massive, massive scale. So there we have it. We've laid the foundation, we've programmed the brain, and we've defined how it takes action. By putting all these pieces together, we can now step back and look at the complete, fully functioning machine we've just built. When you boil it all down, it really comes back to these three core components working in perfect harmony. You've got the physical foundation, giving it that raw speed and reliability. You've got the brain, which is that heavily tested, intelligent algorithm making all the calls. And you've got the action, the smart execution strategies that interact with the market without causing a stir. Each part is absolutely critical. And that really brings us to our final thought. We've just walked through how these incredible systems are built today. But as artificial intelligence gets more and more powerful, and these machines become even more autonomous, it really raises a fascinating question, doesn't it? What will the next evolution of our financial markets even look like? What happens when the machines truly start thinking for themselves?
All right, so everyone talks about the flashy side of algorithmic trading, right? The insane speed, the big wins. But today, we're going to flip the script and talk about something way more important. How you build a system that doesn't just make money, but actually keeps it. It's all about defense.
And I mean, just let that sink in for a second. We're talking about systems where a single typo, just one bad line of code, could literally wipe out millions of dollars in minutes. The very speed that makes these things so powerful is also what makes them so incredibly dangerous.
So that really is the million-dollar question, isn't it? How do you build an algorithm that not only knows how to win, but also knows how to, well, survive? It's one thing to have a great idea. It's a whole other ballgame to build something that can take a punch from the market and keep on ticking.
Okay, so here's our game plan. We'll kick things off by setting the scene, the high-speed, high-stakes world we're in. Then, we'll dive into controlling your bet size and why you shouldn't bet on just one horse. After that, we'll talk about the what-if plan for when everything goes sideways. And finally, we'll put it all together to see how you build a real fortress.
Right, so in this world where trades are happening faster than you can blink, your old-school manual risk management just can't keep up.
No way!
For an automated system, defense isn't something you bolt on later. It has to be baked right into the core code, right from the very beginning.
And a great way to think about this is what we're going to call the two-layer shield. It's a simple concept. You've got one layer that handles all the predictable day-to-day risks, and then you have a second, tougher layer that's all about preparing for the crazy, unexpected stuff that can and will happen.
So let's peel back that first layer of the shield. This is all about controlling your bet size. We're getting down to the nitty-gritty here, the individual trade. The goal is super simple. Make absolutely sure that no single loss can be the one that sinks the entire ship.
And this is a really key concept, position sizing. It's got nothing to do with being a genius stock picker. Nope. It's all about deciding how much skin you're going to put in a game on any single idea. It's damage control, pure and simple. If you're wrong, and you will be wrong, you need to make sure you live to trade another day. Now, it's really important to get this straight. Position sizing is different from diversification. Think of position sizing as your zoomed-in tactical defense. You're looking at one trade at a time. Diversification, which we're getting to next, is your zoomed-out strategic view. You're looking at everything you own. And you absolutely, 100% need both.
Of course, algorithms handle this stuff automatically. You've got simple methods like a risk per trade rule. That's just a hard line in the sand, like we will never ever risk more than 1% of our total cash on this one idea. Then it gets smarter. You have volatility adjustments, where the algo actually pulls back on its bet size when the market starts getting wild and unpredictable, kind of like tapping the brakes in bad weather. And then you get to the really fancy stuff like optimal F, which is some serious math that looks at your past wins and losses to figure out the exact perfect amount to bet to grow your money the fastest over the long run. It's a constant balancing act between being bold and being foolish.
Okay, so you've got your single trades under control. That's great. But what about the big picture? This brings us to the second piece of that first defensive layer. You know the old saying, right? Don't put all your eggs in one basket? That's exactly what this is about.
And here's the secret to real diversification. It's not just about owning 100 different stocks. It's about owning things that don't all go up and down at the same time. You want things that are uncorrelated. So maybe your tech stocks are taking a beating, but hey, your gold position is having a great day. The whole point is to smooth out those crazy ups and downs, to make the journey a lot less nauseating.
And again, this is where algorithms just shine. They can perform asset selection by scanning literally thousands of options to find assets that don't move in lockstep. Then, they might use a cool strategy called risk parity. Instead of putting the same amount of money in everything, it puts the same amount of risk in everything. It balances the portfolio so no single position can tip the whole thing over. And all the while, it's constantly doing correlation analysis, because guess what? The relationships between assets change all the time, and the algo needs to adapt on the fly.
All right, so layer 1 of our shield is in place. We're managing the everyday risks of the market. But what happens when things go completely off the rails? What if your internet connection dies? What if the market data feed just stops? This is where that second layer of the shield, the what-if plan, becomes absolutely critical. This is contingency planning. And listen, the most important word here is proactive. This isn't about reacting to a fire. It's about having the fire extinguishers, the sprinkler system, and the escape route all planned out long before you even smell smoke. It's about having an automated plan ready to go at a moment's notice.
So what does that actually look like? Well, first, you're monitoring everything, constantly. The second anything looks weird, automated alerts start screaming. Third, you've got backups for your backups, redundant servers, different data feeds, the works, ready to take over seamlessly. That's your failover. And if all of that somehow fails, you have the big red button. The emergency protocols kick in, which might mean automatically closing out all your trades to stop the bleeding.
But it's not just about your own tech failing. Your strategy itself has to be tough enough to survive the market's absolute worst days. It needs to be battle-hardened. And that's where stress testing comes into play. Think of it like putting your algorithm into a flight simulator that's programmed for doomsday.
First up, extreme price movements. You just hammer the system with insane scenarios. What happens if the market drops 20% in 5 seconds? You're not just hoping it survives, you're actively trying to break it to find its limits. Test number 2, volume spikes. You simulate a panic. What happens when everyone on Earth tries to sell at the exact same time? Does your algorithm get its orders filled, or does it get trampled in the stampede, unable to get out when it needs to?
And finally, the big one, market stress scenarios. This is where you rewind the clock and force your algorithm to trade through history's worst moments. You make it live through the 2008 financial crisis. You throw the 2020 pandemic at it. You simulate a sudden, shocking news event. You want to know if its logic holds up when it feels like the entire world is falling apart.
Okay, let's pull all these threads together. We've talked about controlling the risk on one trade, we've talked about spreading that risk across a whole portfolio, and we've talked about planning for total system failure. These aren't just separate checklist items, they're all interlocking pieces of one big defensive machine.
And this really lays it all out perfectly. You've got position sizing, which is your frontline defense for each individual trade. Then you zoom out and you have diversification protecting your entire portfolio. And then, wrapped around all of that, you have contingency planning, which is the ultimate safety net for the whole system, protecting you from tech glitches and market meltdowns. See how they all work together? Each one makes the others stronger.
You know, at the end of the day, this is really the main thing to remember. You can have the smartest, most brilliant trading algorithm in the world, but if it's fragile, it's basically worthless. Real long-term success isn't about the genius idea. It's about building an absolute fortress of defenses around that idea. You've heard it in sports a million times. Offense wins games, but defense wins championships. It's the exact same thing here.
So I'll just leave you with this one final thought. In today's markets, having a smart algorithm is just table stakes. Everyone's got one. The real question, the one that separates the winners from the ones that blow up, isn't, is your algorithm smart? It's, is your algorithm resilient?
Okay, so every single second, trillions of dollars are zipping around the globe. It's happening in this world that, let's be honest, most of us never see. A world run by algorithms, by robot traders, moving faster than any human possibly could. So what happens when these robots go haywire? Well, today we're going to pull back the curtain on the rulebook, the invisible guardrails that are supposed to keep our entire financial system from just flying off the rails.
I mean, it's a pretty wild question when you think about it, right? If robots are doing all the trading, who's actually making the rules? You know, if a machine can fire off 1 million trades in the blink of an eye, who's the referee? Who's making sure the game isn't just rigged for the fastest computer in the room? That's exactly the puzzle we're going to unpack. All right, so let's start with the big why. Why bother regulating these robot traders at all? I mean, what's the point of putting speed bumps on what's basically the fastest financial highway on the planet? Well, it turns out it all comes down to a few really core, absolutely essential ideas. You can kind of think of it like a three-legged stool. If one leg is wobbly, the whole thing comes crashing down. First up, you've got fair and transparent markets. Simple idea, right? Everyone should have a fair shot. The second leg is protecting investors, and we're talking about everyone, from huge pension funds all the way down to your personal retirement account. And the third leg, and this is a big one, is maintaining stability. Preventing some tiny computer glitch from spiraling into a massive flash crash that could wreck the whole system. Just about every rule we're going to talk about today points back to one of these three goals.
Okay, so we've got the why down. Now let's get to the who. Who are these market referees? Because this isn't just happening in one country, right? Algorithmic trading is totally borderless, which means the folks in charge have to work together globally. Let's meet the key players.
And yeah, it's a truly global team. Over in the US, you've got the big ones, the SEC and the CFTC, who handle everything from regular stocks to those super complex derivatives. Pop over to the UK, and the FCA is watching over London, one of the biggest financial hubs on Earth. Then you've got ESMA setting the rules for the entire European Union, and in a major Asian center like Hong Kong, the SFC is in charge. And the key thing here is, they're all talking to each other, trying to keep the rules consistent for a market that literally never stops. So we've met the refs, but what's actually in their rulebook? What are the big principles they use to make sure all this high-speed automated trading stays, well, legal and fair?
First up is something called market surveillance. And honestly, you should think of this as high-tech detective work. The regulators themselves are using their own powerful AI to comb through billions, with a B, of trades. They're hunting for these tiny, almost invisible patterns that could signal someone is trying to manipulate the market. It really is like finding a needle in a haystack, only this haystack is the size of a mountain, and it's moving at the speed of light.
Okay, now this next one is a huge deal. It's called best execution, and it's not just some piece of jargon, it's a fundamental promise. It means that a firm has a legal obligation to get the absolute best possible result for their client. And that doesn't just mean being the fastest. Nope, it's a tricky balance of price, speed, and liquidity, all to make sure the client comes first, even when a machine is making the trade. So how do they actually make all this happen? Well, regulators have put a whole bunch of requirements in place. We're talking about things like pre-trade risk controls. Think of them like circuit breakers. There are super strict reporting rules, which we'll get to. Firms need to be registered or licensed. They need to have rock-solid risk management, be transparent about what their algorithms are doing, and make sure everyone has fair and equal access to the market. It's a whole framework designed to lock things down. And this all leads to this fundamental tension, this constant push and pull that regulators have to deal with. On one hand, you absolutely have to ensure stability and protect everyone. You can't have the system blowing up. But on the other hand, you don't want to kill the innovation that's making markets more efficient. If you regulate too much, you could stifle that progress. But if you regulate too little, well, you risk disaster. Finding that sweet spot, that perfect balance, is the name of the game. All right, We've been talking pretty high level so far. We've seen the rules from, 30,000 feet. But what does this actually look like day to day? If you're a firm that does this stuff, how do you take all these rules and actually do them?
Let's zoom back in on best execution to see how it works in practice. It's not something you just do once. First, firms have to create these clear policies on how their bots are going to route trades. Then, they have to analyze the costs and the quality of those trades. They're constantly monitoring how their algorithms are performing. And this is key, they have to document everything. Every decision, every policy, and finally, they use all that info to adjust their strategies and make them better. It's this constant cycle. Set the rules, measure, monitor, document, and then improve.
And then there's the reporting. Oh man, the reporting. We are talking about a literal fire hose of data. Firms have to give regulators everything. Detailed reports on every transaction, complete records of their order books, full audit trails, the whole shebang. The idea is to create this perfect, transparent record. So if something ever does go wrong, the regulators can hit rewind and see exactly what happened, down to the microsecond.
Okay, let's pull back out one last time. We've looked at the why, the who, the what, and the how of regulating these robot traders. But you have to remember, this story is far from over. So what does the future look like in this endless cat and mouse game between technology and regulation?
This quote really nails it. For the firms in this space, it's all about navigating this incredibly complex regulatory world while also trying to stay competitive. They're basically in a race where the rules of the track are changing while they're running on it. It's an incredible high-wire act. And so we're left with this one final massive question. As trading just keeps getting faster and faster, as the technology accelerates, can the rules, which are made by humans, ever really keep up? It's a tough one, and the answer to that question is probably going to define the future of finance for all of us. All right, let's talk about the future of algorithmic trading. We're going to dive into the tools, the rules, and the massive stakes involved in a game that's totally changing finance as we know it. So let's just kick things off with a pretty wild question. What actually happens when the trading bots get smarter than we are? And hey, this isn't some sci-fi movie plot anymore. It's a real question that traders, investors, and even regulators are grappling with right now. It feels like we're standing right on the edge of a new frontier for trading. The tech that's emerging is completely rewriting the rulebook, and it's opening doors to things we couldn't even dream of 10 years ago. So what's really behind all this? Okay, if you look under the hood of this whole transformation, you'll find a brand new tech toolkit. And the two main engines driving it, blockchain and artificial intelligence. Let's get into what these actually are and why they matter so much. First, let's tackle blockchain. The easiest way to wrap your head around it, just picture a digital notebook that's shared with everyone involved. Once you write something in it, say a transaction, it gets locked in with a super strong cryptographic seal. Then it's chained to the entry before it. That's what makes it so secure, so transparent, and, this is the key part, pretty much impossible to tamper with. So, this digital ledger idea, it's a total game changer. It lets us use something called smart contracts. Basically, think of them as agreements that run themselves. They automate trades automatically, so you don't need a middleman. This obviously makes everything way more transparent, cuts down on fraud, and opens the door for completely new kinds of platforms, like decentralized exchanges or DEXs, where people can trade directly with each other. And of course, when you hear blockchain, your mind probably jumps straight to its most famous creation, cryptocurrencies. We're talking about things like Bitcoin, Ethereum, all these digital currencies that use that exact same secure, decentralized tech to work completely outside the old-school banking system. Now, for algorithmic traders, crypto has been like stumbling into a new gold rush. It's kind of like the Wild West, a brand new market that's just defined by these insane price swings, right? This volatility creates massive opportunities for trading bots. They can cash in on those sudden flash crashes where a price nosedives and then shoots back up in minutes. Or they can hunt for tiny little price differences across hundreds of different exchanges, and they can do it 24/7. And when you put the old and new side by side, the difference is just stark. Your traditional stock exchange needs a central middleman, right? And that can slow everything down. But a decentralized exchange? It's built on the blockchain, so it's totally direct. The trades are all handled automatically by the code itself. Poof, the middleman is just gone. Okay, let's switch gears to the other major tool in this new toolkit, artificial intelligence, or AI. If blockchain is the new unbreakable ledger, then you can think of AI as the new brain. We're talking about systems that can actually learn. that can reason, and that can make decisions all on their own, doing things that, until recently, only humans could do. And in the world of trading, AI is basically a super analyst on steroids. It can sift through literal mountains of data to find patterns that a human brain could never, ever spot. Its machine learning models are so smart they can change their own strategies in real time as the market shifts. It can even get a feel for the market's mood just by reading news articles and what people are saying on social media. It's incredible. But then you have the next level up, deep learning. Okay, if AI is the brain, then deep learning is like a brain with all these extra complex layers. And that's what lets it handle really messy, unstructured stuff, like images or just plain text, and find these super subtle patterns that a regular AI would completely miss. So here's the really mind-blowing part. Deep learning can figure out what's important on its own. You don't have to tell it what to look for in all that data. And what does that mean? It means it can cook up trading strategies that are way more sophisticated than anything we've seen before. It can spot risks as they happen. It's just on another level compared to the old models. So, okay, we have these unbelievably powerful new toys to play with. But you know what they say? With great power comes, well, a whole lot of attention from the regulators. And that brings us to the next big piece of the puzzle, the rulebook. It's constantly changing because the people making the rules are basically in a high-speed chase with technology. And here's the fundamental problem they're trying to solve. Modern finance is totally borderless, right? A trading algorithm doesn't care if it's crossing a national border. So the big mission now is to build a single, coherent set of rules that works for the whole world. The goal is to make sure trading is safe and fair for everybody, no matter where they are. So what are they actually doing about it? Well, first, there's a big push to get everyone on the same page, to harmonize the rules across different countries. And get this, the regulators are now fighting fire with fire. They're using their own new tech, they call it RegTech and SoupTech, just to keep an eye on everything. And as you can imagine, data privacy and cybersecurity are absolutely front and center. All right, so that's the tech and that's the rulebook. What happens when these two things smash into each other? That's what we're looking at now, the road ahead. It's a collision course that's creating some huge challenges, but also some absolutely incredible opportunities. It really is like looking at two sides of the very same coin. On one side, you've got these massive challenges, like how do you make a black box algorithm explain its decisions? How do you make sure this stuff is fair? And how do you stop people from just hopping from country to country to find the weakest rules? But then you flip the coin over and you see the opportunity, the chance to build rules that actually encourage innovation, that can adapt as tech changes, and that bring the whole world together. And really, that's the dream scenario, isn't it? The whole point isn't to slam the brakes on progress. It's to steer it, to create a system that lets us use all this amazing new tech, but in a responsible way that keeps the markets, and all of us, safe. So all of this leaves us with one final and I think crucial question. As these incredibly powerful algorithms and these new decentralized networks just keep getting smarter and more complex, can we actually pull it off? Can we build a financial future that is both unbelievably innovative and fundamentally fair? Because honestly, the answer to that question is going to define everything about the next era of finance. You know, what if I told you that most of the trades happening on the stock market right now aren't being made by people at all? Welcome to the absolutely wild world of algorithmic trading, where supercomputers are making millions of decisions every single second. Today, we're going to pull back the curtain on this hidden world and figure out what it all means for the future of finance. So this is the big question, isn't it? It's the one that keeps regulators, traders, you name it, up at night. Are we actually handing over the keys to our entire financial system to a bunch of machines? It's complicated. But by the end of this, I promise you'll have a much, much clearer picture of what's really going on. All right, first things first, let's get on the same page and define what these robot traders actually are. Okay, so think of it this way. Imagine a chess grandmaster who can see every single possible move and countermove all at once in less than a second. That's pretty much what these algorithms do, but their game is stocks, bonds, and currencies. They execute trades faster than you can even blink. And that, right there, gives them a massive, massive advantage in the market. So what's the secret sauce here? What's going on inside the brain of these algorithms? Let's break down the core components.
You know, the funny thing is, the building blocks are actually pretty traditional. It all starts with technical and fundamental analysis, picking the right assets just like a human trader would. Then comes the really heavy-duty math, the quantitative models to build out a trading strategy. From there, they have a super precise plan for how to execute orders to cause the least amount of ripple in the market. And of course, built-in risk management is crucial to stop things from going completely off the rails. The real difference? They do all of this at lightning speed and on a scale that's just impossible for a human brain to comprehend.
But hey, the world of finance never, ever stands still, right? There's a whole new wave of technology that's about to kick algorithmic trading into an even higher gear. First up, artificial intelligence. And look, these are not your dad's old-school rule-based algorithms. No. These are learning machines. They can chew through unbelievable amounts of data, spot patterns that no human would ever see, and actually change their strategies on the fly. We're talking about the Einsteins of the trading world. Then you've got blockchain. The simplest way to think about it is like a super secure, totally digital ledger. It can record every single transaction in a way that's completely transparent and basically tamper-proof. This alone could totally revolutionize how trades are settled, making everything faster, cheaper, and way more secure. And of course, we have to talk about cryptocurrencies. I mean, this is a whole new universe of assets for these algorithms to play in. The crypto market never sleeps. It's 24/7, it's incredibly volatile, and it's completely digital. It's pretty much the perfect playground for automated trading strategies. Wow. Okay, this slide really just lays it all out, doesn't it? On the left, you've got the human trader. We run on emotion, gut feelings, intuition. On the right, the AI trader. It's pure, cold, hard data. And just look at the speed difference. Human reaction time versus execution in milliseconds. And the scale. A person can maybe manage a handful of assets. An AI, thousands. And it never takes a coffee break. It is a completely different ballgame. Okay, so with all this incredible power comes a whole lot of responsibility. This explosion in trading tech has regulators just scrambling to keep up. So what are the new rules for this brand new game? This is the tightrope that regulators have to walk every single day. On one hand, you have this amazing potential for technology to make markets way more efficient. But on the other hand, you've got the very real risk of things like flash crashes and other crazy market events. Finding that perfect balance, that's the key to a healthy financial system. Now, the good news here is that regulators are basically fighting fire with fire. They're embracing something called RegTech and SupTech. That's short for regulatory and supervisory technology. It basically means they're using really sophisticated tech to monitor the really sophisticated tech that traders are using. It's like a high-tech game of cat and mouse, and it is happening as we speak. So what are the big picture goals here? Well, first, it's about keeping the market fair for everybody, not just the giant firms with the fastest computers. Second, it's using all that new tech to get a much better grip on what's actually happening in the markets. And finally, and this is the most important one, it's about protecting everyday investors from the risks of this new high-speed world. So let's put it all together. Where is all of this headed? What does the future of trading actually look like? This quote just nails it, doesn't it? You really can't understand the future of trading if you're only looking at one piece of the puzzle. It's this constant dance between the technology, the trading strategies, and the regulations that's going to shape the markets of tomorrow. So what are the big challenges on the horizon? I mean, how do we make sure that traders, regulators, and the tech folks are all working together to build a market that's stable and fair? How does the industry grapple with the huge ethical questions that come with AI-driven trading? And how on earth do you create regulations that are as fast and adaptive as the technology they're trying to govern? These are tough questions. Which really just leaves us with one final and, I think, fascinating question to think about. As these machines get exponentially faster and smarter, as they handle tasks that humans just physically can't, what's our new role in this financial future? What does it even mean to be a trader, an investor, or regulator in the age of the algorithm?